Volatile day on Wall Street Wednesday. We started sharply lower right now. The market's near the flat line for the S&P 500. The NASDAQ actually turning positive right now. So is this a buying opportunity or should you stay away? Let's ask Ryan Payne. He's president of Payne Capital Management. Welcome back, Ryan.
Fred, great to see you.
Good seeing you too. Now, so should investors buy on this dip or should they stay away? I mean, we had yesterday when it came back, and today it's starting to come back again with chips now up.
Yeah, I mean, we're down maybe 5-6%. I don't know where from the highs we are right now, but this is the second time this year that we've seen a big sell-off. The last one was back in April, and that was a great buying opportunity. I would argue, again, you have a tremendous opportunity to buy stocks. You don't get these sell-offs that often, Fred. You got to take advantage of it.
Buy what at this point?
I mean, I'm like a kid in a candy store when I look at the markets right now, but I think you're smart not to say, hey, I'm just going to put my money into the S&P 500. I mean, value stocks right now are trading at a tremendous discount to growth stocks. So I would have looked at value, and I also looked at overseas markets. I mean, globally right now, we were talking about this earlier, but I mean, European stocks, you're getting like a 5% dividend on a basket of high dividend paying European stocks. And it's kind of ironic given that you're getting negative yields on their bonds. So, I mean, I have to think that there's some value there.
And speaking of yields, we saw the 10-year benchmark dip to a 3-year low today.
Crazy.
So what do you make of that? Should we take that as a serious signal, as a warning that, hey, this economy is headed to a recession, or do you just buy on this news?
Well, I think the herd mentality is kind of playing into this, and it's always dangerous to follow the herd. So when you're seeing big retail money flows going in the same place, and here bond funds specifically, I think you've seen the quarter of all bond inflows over the last 10 months, or a quarter over the last 10 years came in the last 10 months or so, excuse me. That's a sign that probably have some sort of bond bubble forming.
Bond bubble. So don't pour money into bond funds, or if you're still in the bonds, where do you put your money?
Okay, good question, right? So I don't like bond funds specifically because you don't own the underlying debt, right? So if interest rates go up, bond prices go down, now you have all these retail investors in that bond fund selling out at the same time. Very dangerous place to be. On the flip side, if you own your bonds outright, high quality, I would definitely stay towards high quality bonds right now, and those bond funds have a lot of junk in them. Got to be careful about that. They come due, right? If you own your bonds, they pay interest, they come due, they're high quality. That's the only way to really protect yourself if we think interest rates are going up and we still want to own bonds.
And you mentioned value stocks earlier. Would you, if not bond funds, or not bond funds, you're saying, so would you go into stocks, dividend-paying stocks or value stocks?
Yeah, and if you look at the overall market right now, it pays a pretty nice yield. If you get away from just growth stocks, a lot of money is going into these big cap tech stocks. In fact, the S&P now is 30% tech. I made the joke that the S&P is a tech fund and drag right now. So you got to be careful there. But if you just own an outright value portfolio, the dividend yields are pretty rich. You're getting close to 3% yields on, if you look at mid, small, and large cap value stocks. And again, valuations are much cheaper there. So there's a lot of disparity in the market right now, and you can really discern, and you can start putting your money into the things that are really, really cheap.
And lastly, PIMCO is saying that, hey, the U.S. may be going toward the same situation as the Germans and the Japanese, possibly negative yields. Do you foresee that?
Well, never say never, but I have to think that given the fact that our GDP growth is still relatively solid, especially if you look at other economies around the world, you also look at just earnings right now are very, very good. I have to think at some point money's going to start flowing out of bonds, start going to where the real value is. So I'm hard pressed to think we're actually going to get to negative yields. I think it's it's an aggressive call.
Okay, so the fundamentals are still intact then.
Exactly.
All right, thanks, Ryan. Appreciate it.
Thanks, Fred.
Our thanks to Ryan Payne of Payne Capital Management. I'm Fred Katayama, and this is Reuters.